In recent discussions, prominent financial analyst Ray Dalio suggested that the upcoming 5 years will present challenges that few are prepared for. His remarks indicate a significant downturn on the horizon, urging investors to shift their focus from stock prices to the value of the currency backing those stocks. This shift is not merely a strategic suggestion. It is critical as the underlying economic environment transforms in unprecedented ways. To fully unpack Dalio's statement, we need to explore the historical context, the implications of current economic policies, and the potential future of gold and silver investments. Understanding the current market dynamics requires a thorough examination of historical trends. The United States has experienced several significant market bubbles, particularly from 1923 to 1929, during the dot-com boom of the late 1990s, and more recently, from 2009 to the present day. Each of these periods was characterized by extraordinary growth in asset prices, driven largely by speculative investment, and, in many cases, by an oversupply of cheap money. During the late 1920s, for instance, the stock market experienced unprecedented growth, with the S&P 500 more than doubling in value. Similarly, in the late 1990s, the dot-com boom saw the Nasdaq skyrocket as technology companies proliferated, pushing the index to extraordinary heights. Fast forward to today, and we see the S&P 500 increasing sevenfold, and the Nasdaq 100 rising even more dramatically. This astronomical growth has been largely fueled by a surplus of cheap money, leading to inflated asset prices that are increasingly disconnected from the underlying economic fundamentals. The Federal Reserve's monetary policies have played a significant role in creating this environment, making it easy to understand why these bubbles formed. Low interest rates and aggressive quantitative easing measures created an illusion of stability, encouraging excessive risk-taking among investors. The perceived safety of the stock market drew in massive capital inflows, as investors sought to capitalize on rising asset prices. However, as we know, bubbles eventually burst, and the crucial question now is how and when this will occur, along with the ramifications it will have for the broader economy. As corporations, families, and governments made long-term commitments based on the prevailing environment of cheap money, they inadvertently created a precarious situation. The current shift away from low interest rates to more normalized financial conditions will act as a rude awakening for many market participants. Suddenly, the underlying assumptions that supported various investment strategies will be challenged, leading to a re-evaluation of risk across the board. Investors should be acutely aware that these changes are already underway, with signs of strain appearing in various sectors of the economy. For instance, rising interest rates may lead to increased borrowing costs, negatively impacting corporate profits and consumer spending alike. As financing becomes more expensive, businesses that over-leverage themselves during the era of cheap money may find themselves in increasingly precarious situations. This dynamic creates a ripple effect throughout the economy, raising concerns about liquidity and solvency as financial conditions tighten. While many market participants remain fixated on earnings reports and interest rates, they are neglecting the broader political and economic upheaval that is brewing beneath the surface. The uncertainty surrounding government policies, potential regulatory changes, and escalating geopolitical tensions further complicate the investment landscape. Investors should also be cautious of inflationary pressures that are emerging as a result of fiscal and monetary policies aimed at stimulating the economy. Such inflation can erode purchasing power, affecting both consumers and businesses, and could lead to a scenario where central banks are forced to choose between stifling growth or allowing inflation to spiral out of control. The United States is currently experiencing a political divide unlike anything we have seen in recent decades. This division isn't just a matter of party politics, it is leading to real-world implications that could profoundly impact financial markets. Proposals such as Texas's serious consideration of a state-backed cryptocurrency pegged to gold exemplify how states are looking to distance themselves from federal monetary control. These discussions signal a broader trend toward decentralized financial solutions that challenge the existing monetary system. In a more radical move, Alaska has taken significant steps by passing legislation that recognizes gold and silver as legal tender. These developments indicate a noteworthy shift in how states are viewing their economic independence from federal monetary policy. If more states follow suit, it could weaken the Federal Reserve's influence, and reshape the landscape of currency and investments. The implications of such political shifts are profound and multifaceted. A move towards state-backed currencies could encourage other states to explore similar options, potentially leading to a fragmentation of the U.S. dollar's dominance in both domestic and global markets. This scenario raises serious questions about the future stability of the dollar and its role as the world's primary reserve currency. As states explore alternatives to the U.S. dollar, the implications for investors are far-reaching and complex. If a gold-backed currency emerges, it could provide a stable alternative to the fluctuating value of the dollar, presenting a compelling case for diversifying investment portfolios. Such a development would effectively undermine the Federal Reserve's power to manipulate monetary policy, leading to a potential destabilization of the existing financial order. Consequently, investors must reconsider their strategies in light of these changes, as traditional economic metrics may no longer suffice to gauge market direction. Furthermore, the rise of alternative currencies could usher in a new era of monetary policy where decentralized and state-backed currencies coexist alongside traditional fiat currencies. This scenario may lead to increased competition for the U.S. dollar, potentially diminishing its status as the world's primary reserve currency. The ramifications of this shift would reverberate throughout the global economy, prompting central banks and investors to reevaluate their positions. Given this backdrop, it is clear why gold and silver are gaining traction among investors. These precious metals have historically served as safe havens during times of economic distress, providing a reliable store of value in turbulent times. As fears of a stock market correction loom, gold is witnessing renewed interest among investors who are seeking protection against potential losses. Unlike paper currencies, gold and silver possess intrinsic value, providing a hedge against inflation and currency devaluation. In an environment where the dollar's purchasing power is increasingly in question, more investors are turning to these metals as a form of wealth preservation. This shift in investor sentiment isn't merely a reaction to potential economic downturns. It reflects a deeper understanding that central banks will likely step in to manage any fallout from a market collapse. The expectation of monetary intervention is driving money into gold as a protective measure. As central banks respond to economic challenges by increasing the money supply, the value of fiat currencies may decline, further boosting the appeal of tangible assets like gold and silver. Historically, gold has been viewed as a safe haven during periods of economic uncertainty, and the current climate is no exception. Currently, the stock market's gains are highly concentrated among a small number of tech stocks. For instance, the top 5 companies in the Nasdaq 100 have significantly driven the index's performance, creating a lopsided market where a few players dominate the narrative. If these stocks falter, the broader market may follow suit, revealing the fragile nature of the current rally. Investors must prepare for a scenario where market sentiment shifts rapidly. If economic indicators such as unemployment rates begin to worsen, the emotional reaction from investors could trigger a sell-off, leading to further declines. This cycle of fear and uncertainty is what makes gold and silver appealing in such turbulent times. Moreover, the concentration of wealth in a few major tech companies raises serious concerns about market sustainability. When a significant portion of market gains is driven by just a handful of stocks, the risk of a sharp correction increases dramatically. If investors begin to realize that the rally is not as broad-based as it appears, we could see a rapid re-evaluation of stock valuations. This moment of reckoning could prompt a rush into safe haven assets like gold and silver, driving their prices up significantly. The interplay between stock market performance and the attractiveness of precious metals will be critical for investors to monitor in the coming months. As we look to the future, many analysts are predicting a downturn in the stock market. If this occurs, gold and silver could experience substantial upward pressure, as they have historically done during periods of market volatility. The current situation mirrors past market corrections, where commodities, particularly precious metals, thrived while stocks struggled. Historical data shows that during previous market corrections, gold has often performed well as investors seek safe havens amidst chaos. Market analysts are closely monitoring gold's price action. If it breaks through significant resistance levels, it could signal the beginning of a more explosive rally. Smart money is already positioning itself in anticipation of this shift, recognizing the potential for dramatic gains as capital flows from traditional equities into safe havens. Investors who understand these dynamics may find lucrative opportunities in gold and silver as the market adjusts to changing economic economic conditions. Given the potential volatility in equities, diversifying into precious metals can serve as a strategic hedge against losses in other asset classes. While gold and silver prices are rising, it's important to also consider the mining sector. Historically, mining stocks have tended to lag during market corrections but can experience rapid gains during rallies. As gold begins to assert itself, we can expect mining stocks to follow suit, potentially outperforming the underlying metals. Investors should closely monitor this sector for opportunities as gold prices rise. Mining companies often face their own set of challenges, including operational costs, geopolitical risks, and regulatory issues. However, when gold prices rise, these companies can benefit significantly from increased profit margins, creating a compelling investment thesis for those willing to navigate the complexities of this sector. The potential for outperformance in mining stocks makes them an attractive option for investors looking to leverage the rising gold market. When the broader market recognizes gold's strength, mining stocks could experience a dramatic resurgence, creating significant opportunities for those positioned correctly. Investors should keep a close eye on mining stocks and their performance relative to gold prices, as this relationship can provide valuable insights into market sentiment and potential future trends. One of the crucial aspects of market behavior is the role of emotions in investment decisions. Fear and greed often drive market dynamics, and as uncertainties increase, investors may react impulsively. The potential for a stock market correction could lead to a flight to safety, with many investors reallocating their portfolios toward gold and silver. Understanding these emotional triggers can provide valuable insights into market trends. As economic indicators begin to signal trouble, the emotional response from investors could trigger a cascade effect. Once confidence starts to wane, panic selling can ensue, pushing more investors into the arms of precious metals. Anticipating these emotional shifts allows investors to position themselves advantageously within the market. Those who can understand and predict market psychology may be better prepared to capitalize on the opportunities presented by a turbulent market environment. In this context, educational resources and analytical tools can play a critical role in equipping investors with the knowledge they need to navigate these complexities effectively. In conclusion, the next 5 years are shaping up to be unlike any we have encountered in modern financial history. The combination of political upheaval, economic instability, and the potential for significant market corrections necessitates a radical shift in how investors approach their strategies. Gold and silver are not just commodities, they are pivotal assets that can provide security in uncertain times. As we move forward, keeping a close watch on both economic indicators and the political landscape will be essential for making informed investment decisions. As Ray Dalio suggests, it's time to look beyond stock prices and consider the value of the underlying currency. By doing so, investors can better navigate the dramatic shifts ahead and position themselves for success in the evolving financial landscape. Understanding the intricate relationships between political developments, economic policies, and market dynamics will empower investors to make strategic decisions that align with their financial goals. The time to adapt and evolve is now, and those who recognize the signs of change will be best positioned to thrive in the years to come.